All right, welcome everybody. Thank you so much for joining us for this special Halloween presentation on the most terrifying mistakes in the world of self-directed IRAs and 401ks. I'm Sean McKay, and this is an American IRA presentation. Our marketing director, Michelle, put together some special slides here, so I can't take any credit for the visuals being upgraded from what I typically have here. So we're going to have a little fun with this. Certainly, we're usually talking about the most positive and beneficial aspects of self-directed IRAs and 401ks, but today we're going to delve into some of the things we need to make sure that we're aware of as we're either launching our self-directed career or we're looking to make the next investment. Hopefully these tips will be useful so that you don't have to make these same mistakes yourself. So before we delve into it, I'm just going to do kind of a quick wrap up over the next few minutes and just make sure we're all on the same page. Certainly many of you may be clients of ours already, and we appreciate that, but there are some individuals that will listen to this who may not be familiar with self-directed IRAs. So when we hear the term self-directed, I want to make sure we're understanding two things. The first is, as the name indicates, these are self-directed retirement accounts, meaning that you as the account holder are picking the investments for your portfolio. So this is certainly a departure from working with an advisor who might be picking investment products. You are the captain of the ship. You are the one that is out there identifying the investments for your portfolio. The second concept is when we talk about a truly self-directed retirement account, we want to make sure that we're clear that you can still make investments with us in stocks, bonds, and mutual funds. But really what makes us unique at American IRA is the ability to invest in what we consider alternative assets. So that can be real estate, debt instruments such as mortgages, private placements, which really is just another way of saying companies that are not publicly traded like IBM, Exxon, and Apple, and also physical precious metals such as gold and silver. We're also seeing clients that are starting to investigate new concepts such as cryptocurrencies like Bitcoin, Ethereum, etc., to add to their portfolio as well. Now at American IRA, we really give you the best of both worlds. We give you that local bank feel in that we have done a great job of cultivating a client base of individuals that we can have real legitimate long-term relationships with, but we also give you the safety of being a fully integrated financial services firm, meaning that our trust company, our parent company that allows us to be in business, has the same ownership group as does our administration company at American IRA. So really why that's important to you as the client is that unfortunately the scary aspect of being a self-directed provider is that many of those companies are reliant on third parties that can decide that they are no longer interested in providing trust services, which forces that self-directed company to really have to scramble. And sometimes they have a very limited period of time to find another trust company to be in business. But as I said, we're fully integrated. So ultimately, that gives you a lot of safety as a client and understanding that we have the same ownership group, and so we're able to provide services regardless of the financial climate and what's happening with regulations. Now, we were founded in 2004 by Mr. Jim Hitt, and our headquarters is in Asheville, North Carolina. We're a boutique service provider. We're never going to be a Bank of America in size. We have over 400 million in assets. And we do have thousands of clients that live nationwide. Some even live internationally, and they invest all over the place in the States and outside the States. Now, we really differentiate ourselves in a few ways. As I mentioned, long-term relationships. We're able to have those long-term relationships with clients because especially our senior staff has been with our firm for many years. And so our different department heads have been with us 8, 9, 10 years. I've been lucky enough to be with this firm for 11 years. So you're going to find there's a lot of continuity at our firm at American IRA, which means we're with you throughout your career, and we're also very knowledgeable because of the education we've received in-house and also our experience as investors ourselves. And our fees are very unique. What you typically find in the self-directed space is that as your account balance grows, so does your annual fee. And our thesis is that that's really not fair because these are self-directed accounts. We're not advising you on products that you can invest in due to regulatory elements. And so really the way our fees work is for IRAs, your annual fee is capped at $285 a year. Now the solo 401ks, which is a very unique product, you add another $300 a year for the plan document fees. It is certainly a more complicated product. And so ultimately our fees are really, really interesting and kind of a unique proposition in the self-directed space, which allows you to keep more of the profit that you're making in your self-directed investments. So the way the IRS code is written is it actually tells us what we cannot invest in with our IRAs and 401ks. So this is by no means a complete list, but certainly some of the most prevalent and popular investments that we see clients make. So when you look at real estate, any type of physical real estate can be owned directly by your retirement account. So anything from raw land to condos, townhouses, single-family houses, commercial buildings, apartment complexes, industrial buildings, all of those assets can be directly owned by your retirement account. Now, your retirement account can also be the lender. It could be the bank many times for other investors or entrepreneurs. And so that may be in the form of a deed of trust or a mortgage, depending upon the state. Or if it's secured by business equipment, for example, it can be in the form of a UCC1, which is basically that version of a mortgage to secure your money. Now, we also see a lot of clients that will invest in deals where there's perhaps an LLC involved. So they're going to be one of many owners of an apartment complex, for example. And so that IRA will typically become a member of a single purpose LLC, and that LLC will then go on to acquire the 100-unit apartment building, the industrial building, whatever the case may be. And as I mentioned earlier, there are a variety of assets such as privately held companies, and we'll actually delve into that a little bit today in terms of some things to just be cognizant of when you're investigating a potential opportunity for investment. So we're going to dig right into it now. And so the first fatal mistake that we see with clients is not understanding the difference and especially the difference in outcomes for unsecured loans versus secured loans. So when we look at a secured loan is the most typical type of loan that you'll see, especially in the real estate arena. If you go to a big box bank and you get a mortgage from them so that you can buy a residence for you and for your family, that is going to be a secured loan. The bank is going to need a promissory note, depending upon the state, either a deed of trust or a mortgage. So for example, North Carolina is a deed of trust state. South Carolina is a mortgage state. They're also going to want to be the loss payee on hazard insurance. They're going to require title insurance at closing, and that property is going to be closed by the appropriate professional dictated by that state. So for example, both North and South Carolina, it's preferred, and it's really from a secured lending standpoint, really mandatory that that loan, that real estate closing takes place with a real estate attorney. In other states, it's escrow offices or title companies that do similar transactional closings. But again, every state is different. But in the Carolinas, for example, it's a real estate attorney that will close that. Now, conversely, a unsecured loan will just simply have a promissory note. So there's not the mortgage or deed of trust or any of the other elements associated with getting this loan worked through. So when you look at the possible results, anytime you make a loan, it's really important to understand there are basically two general outcomes that your loan will fall into the category of an end result. So scenario number one is probably ideal for all parties, where the borrower who is borrowing money, in this case from an IRA or 401k, is able to make payments to the retirement account, performs as the arrangement dictates, and ultimately, at some point in the future, that loan is paid back, the remaining balance is paid off to that IRA or 401k, and everyone moves forward with their transaction. That's most typical. Basically, that's a performing note. Scenario number 2 is, regardless of the specific circumstances, the end result is the borrower is not able to perform. They're not able to make payments, or they're not able to sell the property that was the fix and flip or the new build, what have you, and they're not able to essentially pay that lender back the money per the agreed upon terms. So if scenario number 2 happens, where the note does not get paid off as it should have, then really this is where it's most important to understand secured loans versus unsecured loans. With a secured loan, the lender can go through the appropriate process for that state to foreclose and actually take possession of the collateral, or in this case, the property. So the lender goes from being the lender lending somebody else the money to going through the foreclosure, so that the lender then becomes the owner of that asset. Conversely, with an unsecured loan, unfortunately, what we see is most times that lender does not have any legal recourse to go through a process to gain ownership of the property that they were supposedly lending on. So always check with your attorney, really understand the technicalities of where you live in that foreclosure process. But as a general note, unsecured loans can have a very scary negative outcome if it doesn't go as everyone hoped. Now, I really want to make sure that I drive home this point. It's so critical to understand the difference between the intentions and the realities of the loan. What the borrower might tell you as the lender is that their intention is to use the money so that they can buy 123 Apple Street in Charlotte, North Carolina, for example. The reality is they're not willing, as the borrower, to go through the process to secure the money with a mortgage or a deed of trust. And there might be a variety of reasons where they're unwilling to or unable to, but the net result is they're not securing that money. So they could use the money for the house. They could use the money for a brand new BMW convertible. The reality is without the mortgage or the deed of trust, if that borrower does not perform, you're in some serious trouble as the lender. So you want to make sure they can give you whatever sort of articulation of reality they want to, but they need to make sure, for you to be in the best position as the lender, that your money is actually secured. The second concept is lack of cash reserves. So again, this typically will be in a real estate transaction. So the retirement account is going to purchase either a rental property, a new build, or a fix and flip house. So the client has $100,000 in their retirement account with us, and they believe that they could purchase a property, including the closing costs, for $60,000 and put $40,000 in rehab money and sell it for $150,000. So they'll be all in at $100,000, and they'll sell the property for $150,000. So even after realtors, commissions, and what have you, that's a great investment where they'll make a lot of money. If you're anything like me, however, unfortunately, sometimes the rehab goes over budget. And so the rehab costs may be much more, or even a little bit more than the $40,000. The problem is that account holder did not have any sort of cushion in their investment. They were anticipating spending essentially every potential dime in their retirement account to do the deal. So even if the rehab ended up being $44,000 instead of $40,000, that's a real problem, and that account holder is going to need to really hustle to find a way to bring in additional capital. They cannot use their own money because that's kind of a whole situation in and of itself. But basically, after the time of acquisition, the account holder cannot bring their personal money into a transaction. So it's really important. You may have heard the term margin of safety in your investing. In this case, to me, the margin of safety is if you have $100,000 in your account, you're not planning to spend the full $100,000. You might be planning to spend $80,000 or $85,000 with the thought that if it goes over budget, $5,000 or $10,000, you can still do this cash deal A to Z. So the third concept is waiting for a home run loan. So for those of you that are really entrenched into the real estate community with real estate investing, you see that there's a lot of quote unquote hard money lenders out there, individuals or retirement accounts that are willing to lend money to other investors, and they charge a much higher rate than the bank does because they're providing a unique service. If the borrower could go to the bank, they had the necessary time to close the deal, they had the necessary down payment money, etc. Most people would choose a bank, quite frankly, because in this environment, they might get a loan for 4 or 5% from a bank, but they're going to a hard money lender for a variety of reasons that might charge 10, 12, 15, 20% to lend the money. And so ultimately, what we're going to discuss today is the IRA or 401k being a hard money lender. They hear about these really substantial returns, 15, 20 plus percent, and they want to get those sorts of returns too inside their retirement account. The challenge is, it's not that people do not get 20% on their money for being the lender. The challenge is that a lot of these investors are coming into the game and they don't have a lot of relationships with quality borrowers to lend to. And so they're left with essentially a small sample size of potential loans to make. And so what you see is that the lenders that are out there making these substantial returns, they have a tremendous amount of relationships, people bringing in unique deals all the time, and some of them have very short fuses, and the borrowers are willing to pay substantial returns just to get that deal closed because they have a big paycheck at the end of the rainbow. And so ultimately, it's not that 20% isn't possible. It's just very, very difficult without a tremendous amount of relationships to go out there and source deals. You'll also find that usually on really high rates of return on loans, it's typically due to some creative elements in that loan structure. It usually doesn't say on a promissory note, I'm going to pay somebody 25% to borrow their money. Usually there's a stated interest rate, and sometimes there's a bit of equity kicker on the back end so that when that fix and flip is done, for example, that lender also makes a percentage of the net profit from that flip. So it might be, I'll lend you my money at 6 or 8%, and I want 10% or 20% or whatever it may be of the net profit when you sell that property. So that's a lot of times how you get to these really impressive numbers of how someone makes 25% lending money. So what I always think about when I'm lending money out of my retirement account is, am I willing to wait perhaps 6 months or a year or so to get one loan where I can make 20%? Or am I looking to keep my money working at a lower rate of return of maybe 10 or 12%, but keep it working consistently throughout the year? So that's ultimately something that you have to answer yourself. But if you're making 20% on a 6-month loan, but you only do one of those loans every 3 years, then you're actually ending up with a smaller account balance after that 3-year period than someone who was lending money at 10%, but they were keeping their money working for 11 months out of each year. So the next concept I want to discuss is the idea of complicated opportunities, and this really revolves around the idea of somebody who's looking to invest in a privately held company with their retirement account. So again, this is not the publicly traded companies where there's a lot of regulatory oversight in terms of the way the accounting is done, and there's many layers to that company. This is perhaps even a very small company, maybe a startup company in your own community, and a lot of times individuals will get enthusiastic about the opportunity, not based upon the investment itself, but more so based on what I consider the flash of the individuals that are running this company. And so it's really important as you're analyzing a potential private company to certainly want to know the principals, the decision makers, because obviously they're going to drive that company to be successful or flounder, but also understanding intimately what they're actually investing in. And so we'll see that some of these firms will come out with these very flashy professional marketing materials with a lot of really pretty people in the pictures and a lot of general projections about how much money you can make in a 3 and 10-year period. But when you're really trying to drill down, you're unable to understand exactly what the business model is. It seems very complicated. There's a lot of terminology about its proprietary information, and every business to some degree has a secret sauce. But if you can't even understand the fundamental aspect of what you're investing in, then it may or may not be the right opportunity. I'm never going to tell a client, because it is self-directed, hey, I think you're investing into what I consider a potential Ponzi scheme, which is obviously kind of the worst case scenario. But if you can't explain in a sentence or two what the company actually does that you're investing in, it may or may not make sense for your portfolio. And as I look back at the unfortunate situations that clients with different firms have invested in over the years, you do find that there is that cadence where it's very vague. Usually it's investing in a wide array of opportunities that are not correlated in any way. And so they might have some traders in London trading currencies, and they have interests in gold mines in Africa, and they're doing mezzanine loans in California, and all these things that are really not tied together in any way, shape, or form. If that company is so widespread, it's very possible at the very least they're not going to be tremendously competent at all of those things simultaneously. So the more you understand, the more you feel like you can wrap your head around what they're trying to accomplish, the better. We all want to make 50% on our money each year, but nobody wants to lose their entire principal as well. So the next one is timing the market or opportunities as it pertains to your retirement account. So in my mind, I see this in kind of a couple of general ways that this comes about. The first is a client doesn't want to open their retirement account until the stock market hits a certain level. Whether it's the Dow hitting a certain number, the S&P 500, they have some magic number in their head, or they want to wait to open their account with us until they find exactly the right self-directed opportunity to invest in. And that's totally understandable. You want to make sure that you've identified where you're going to be going with your money. The challenge is that what will happen in reality is I will get a call or an email from somebody, and this happens almost every day of my work life, and they'll say, hey, Sean, I heard you speak at an event 5 years ago or 8 years ago or whatever the case may be, and I just found this great real estate deal, and I got to put the offer in today. And as we drill down to the situation, we realize they don't have an account with us, they don't have the account funded, and they're needing to move forward on something immediately, but they're not set up with their self-directed account. So the way that we found to help combat that is to help clients with getting their accounts set up and at least partially funded ahead of time so that you can move forward with that offer to purchase, because certainly real estate, especially in today's world, is so time sensitive. You need to make sure everything is constructed and set up ahead of time so that you can sign around that offer to purchase with the IRA or 401k as the buyer. You have that earnest money or due diligence money in your account to get to that closing attorney, for example, and your IRA or 401k can act quickly and many times as a cash buyer if you have the cash in your account. So that kind of puts you at the top of the list for individuals that are selling their property. So again, we try to make it as easy as humanly possible. We don't actually charge you your annual fee on your IRAs with us until you make your first investment. So you can get that account opened and funded, and that $285 on the IRAs does not start until your first investment is made. Now, the solo 401ks are a different animal. There's a lot of work that goes into creating the plans, and so those annual fees do kick in when you open that account. So again, I really highly encourage you to get that account opened and at least partially funded so that you can start to move a process forward with that offer to purchase. So as you look at kind of the macro of these opportunities, first you open and fund your account. Then you select the investment for your portfolio. You then work with our team to sign around the paperwork so that your IRA or 401k can make the acquisition. And then finally, your IRA or 401k actually owns that asset directly, whether it's a private placement, a piece of real estate, a loan, cryptocurrencies. Your IRA or 401k owns that investment. So I really appreciate it, everyone hanging in with us today. My contact information is here. Definitely let us know if we can help moving forward. Again, I'm Sean McKay with American IRA. My email is Sean, SEAN, at AmericanIRA.com. Our headquarters is 828-257-4949. And also you can call us toll free, 1-866-7500 IRA, which is 472. And check us out at our website, AmericanIRA.com. And certainly feel free to check out our socials as we're adding content. Hopefully that's valuable for you moving forward. And we do a number of webinars and live events, so definitely stay tuned, and hopefully we'll see you at an event or a webinar soon. Thanks so much, everybody.